I think the first thing to understand, and this is a point that actually the central banks understand, is that it's not going up. It's not gold going up. Its currency is going down. So that's the first thing and it's a very, very important distinction. The Bank of China, for example, you think it's buying gold. No, the emphasis is that it's selling dollars and it's selling euros. And other central banks are doing the same thing. I mean, they're not necessarily saying that the whole thing is going to fall apart. What they're saying is that there is now a greater risk in paper currencies, so we need to adjust our reserves accordingly. And so that's what they've been doing. There is also a geopolitical element in it, because they can see that Russia and China have accumulated large quantities of gold. If you're a member of the Shanghai Cooperation Organization, or an affiliate or associate, dialogue partner, I think is the term as well, then, in various meetings, you will have discussed gold with, your opposite numbers. And I know pretty well, what the discussion is, likely to be. It's likely to be, that the West, the dollar is toast over time. Anyway, we need to move away from the dollar because we don't want the American interference. That actually could be rather nasty for the dollar, so we need to have gold to protect our own currencies. So, the whole thing is there. And also, if you go back to the St. Petersburg International Financial Conference back in 22, this was after the West had stolen Russian reserves to the tune of over $300 million. Putin said quite clear, this is what these guys do to you. So don't have your eggs in the Western basket. Be as independent as you can. And furthermore, if you've got any gold stored in, with Western central banks, in the Western alliance, you would be wise to get it out. So you can see that there is a far greater understanding of the role of gold in this current situation than there is, let us say, in Western financial markets. They're beginning to learn. And I mean, I'm looking at gold as we're talking. Today's the 22nd of January. Yeah. Gold price is 2757. That's literally within $30 odd of the all-time high, which was back last early November. So, it looks like it's got enough momentum to go higher. But I mean, actually what's happening is that it's going lower. The dollar's going lower. Now, the reason the dollar's going lower is we've got a new president who's a spendthrift, and he's going to introduce tariffs against China and against the European Union in particular. And the effect of that is that the consumer is going to have to pay higher prices. The consumer price index rises. What can the Fed do? Not a lot. It can't cut interest rates. And then you've got the budget deficit, which I think will be somewhere, it could be $2.5 trillion. And that's just inflation. That's debasement of the currency being injected into GDP. And non-Americans, foreigners holding dollars are watching this. And this is the assessment they're making. They can see that, interest rates are going to have to rise. They can see that the US economy, while it appears on the surface to be growing, in fact, it's not productive. If anything, it's an inflationary form of growth.
One thing that could really drive this shift hard is the massive mountain of debt that governments around the world have accumulated. In the West, we are so far behind in understanding just how dire the situation is. The psychology of investors, policymakers, and the general public remains largely disconnected from reality. People still trust fiat currencies, still believe in government bonds, and still assume that their retirement funds are safe. But the reality is quite the opposite. The value of fiat currencies is on a relentless downward spiral, and when this realization finally sets in, it will be too late for most people to act. The mining sector is another major indicator of this shift. Right now, gold and silver mines are incredibly cheap. If you have even a basic understanding of the relationship between fiat currencies and precious metals, then you already know what's coming. Institutions, hedge funds, and large-scale investors will switch rapidly out of overvalued tech stocks and other speculative assets into real, tangible wealth when the next financial crisis hits. But the critical question is, how many financial analysts are actually paying attention? How many brokers are truly prepared for what's coming? The answer is very few. The mining sector has been ignored for years because it was considered unprofitable, unsexy, and irrelevant. No one wanted to put money into something that wasn't delivering quick returns. But that's precisely why there is such an incredible opportunity here. The undervaluation of mining stocks is historic, and when the tide turns, those who have positioned themselves correctly will reap the rewards. A lot of people are surprised that central banks, especially the Chinese and other BRICS nations, continue to buy gold at an unprecedented pace. The mainstream media either ignores this or pretends it isn't happening. But make no mistake, they aren't accumulating gold because they think it's a bad investment. They're doing it because they understand what's coming. They know that it's not gold going up, it's fiat currencies going down. This is an absolutely crucial distinction to make. When people finally wake up to the fact that the price of eggs, coffee, housing, and everything else isn't really going up, but rather that their currency is losing value, confidence in fiat money will collapse. When that happens, the dollar, the euro, the yen, and the pound will all be significantly lower. That's the inevitable reality. Most investors, however, don't grasp this fundamental truth. They look at gold and think, wow, gold is going up. Maybe I should buy some after it pulls back. But they fail to understand that gold isn't rising in value. Their currency is sinking. If they wait, they may never get another chance to buy at these levels. Right now, gold is trading around $2,712 an ounce, challenging recent highs. If it breaks through these resistance levels, it will continue climbing. But the question remains, do you really want to wait? Do you want to risk missing the opportunity to protect your wealth? This brings us to the critical issue of physical versus paper gold. Many people assume that owning gold ETFs or other paper-based gold instruments is the same as owning the real thing, but it's not. Paper gold is a promise, physical gold is a reality, and when the financial system is under stress, promises often get broken. Investors need to be aware of how the ETF system actually works. Most of these funds don't truly hold gold on behalf of their shareholders. Instead, they operate on a system of counterparty risk and fractional reserves. In other words, if a major crisis hits, there's no guarantee that you'll ever get access to the actual gold that you think you own. And that's why the best strategy isn't trading gold, it's accumulating it. Forget about timing the market. Just keep stacking, whether it's coins, bars, or other physical assets. Make sure you actually own it, not just a paper claim on it. Silver, in particular, is an interesting case because it has historically been more volatile than gold. The gold-silver ratio is currently sitting at extreme levels, 85:1 or higher, which is completely irrational. Historically, the ratio has been closer to 15:1 or 16:1. That tells you one thing. Silver is severely undervalued. When gold moves higher, silver will move twice as fast. That's why silver is often referred to as gold on steroids. The key takeaway is this. The purchasing power of fiat currencies will continue to decline. This isn't speculation, it's mathematical certainty. The only question is whether you position yourself ahead of time or wait until it's too late.
And the US is in a debt trap. And, Trump, he's not very much liked in Europe, except by, if you like, the people who are sort of anti-socialist, who are gathering, incidentally. I'm not saying that, what he's doing is all bad by any means, but on economics, I'm afraid that he's going to drive up the rate of inflation, which, put another way, is the purchasing power of the dollar going down. Who's going to want to buy the dollar? Who's going to want to fund government debt? At this rate, 5%? Well, it's 4.75% or something on the 10-year US Treasury. No, I don't think so. 5%? No, maybe not. You could be looking at 6-7%. Gets there, what happens to the arithmetic about the US government debt? Oh my God, it's getting worse and worse and worse. No, we just get out, don't get involved. And if anything, if we got dollars, get out and go and buy some real money with it.
What about silver? What will be the trigger for higher silver prices?
Well, I think it's more the commodity story that you brought up just a moment ago. It's interesting. Silver in the past has always been roughly twice as volatile as gold.
Yeah.
So we hang on to that sort of idea as silver bulls that, gold, if gold breaks through this, 2,800 level, let's say, then I think silver will be, shooting off, because I think there comes a point where people look at it and they say, gold's gone up. It's now going into new high ground. Silver's been left behind. We got to buy silver. Yeah. So I think at that stage it rockets. It could be starting to rocket now. Basically it's kept pace with gold last year. They were both up about 25-26% or something like that. If I look at the gold silver ratio at the moment, it's just under 90. That's crazy. Absolutely crazy. On the industrial side, I mean, it's not priced as money. This is what that ratio is telling us. If it was priced as money, it would be under 20. Not priced as money. It's essentially an industrial commodity with, if you like, money sentiment in it. But it's been in deficit, according to the Silver Institute, for the last 4 years. So this is a commodity which the whole commodity whole commodity complex begins to move higher on the back of gold. I think silver will be leading the charge.
As we move further into 2025, the cracks in the Western fiat currency system are becoming undeniable, and gold's role as a safe haven asset is more critical than ever. Despite repeated attempts to paint a rosy picture of economic stability, governments across the West are failing to address their unsustainable debt burdens, and central banks are running out of policy tools to contain the inevitable collapse. The real story of gold isn't that it is rising in value, it's that fiat currencies are losing theirs. The global financial elite would rather have people believe that gold's price movements are unpredictable, but the reality is that gold has been a silent witness to the erosion of monetary credibility for centuries. We are seeing a seismic shift in global monetary policies, with central banks across the world, particularly in the East, accumulating gold at record levels. China, Russia, and other BRICS nations have been aggressively stockpiling gold while simultaneously reducing their exposure to U.S. treasuries. This is not an accident, nor is it speculation. It is a strategic repositioning to hedge against the collapse of the Western fiat system. The motivation is clear. These nations have learned from history. They understand that the U.S. dollar's reign as the global reserve currency is nearing its end, and they are preparing for a world where the rules of international trade and finance will no longer be dictated solely by Washington and Wall Street. For years, the mainstream financial media has dismissed the idea that gold-backed trade settlement could ever materialize. However, with the recent moves by the BRICS nations and their allies, we are witnessing the early stages of a multipolar monetary system in which gold plays a central role. We've already seen bilateral trade agreements between Russia and China settle in local currencies, bypassing the dollar entirely. Now, the discussions around a BRICS trade settlement currency backed by gold are gaining traction. The resistance to this idea from Western financial institutions is telling. They know that once a credible gold-backed alternative to the US dollar exists, confidence in fiat currencies will erode even further. One of the most important factors contributing to gold's long-term appreciation is the unsustainable debt burden carried by Western governments. The U.S. federal debt alone has surpassed $36 trillion, and with annual budget deficits consistently in the trillions, there is no politically viable way to bring it under control. Historically, governments have had two options to deal with excessive debt: outright default or inflation. Given that default is politically unthinkable, inflation is the only path forward. Inflation is the most insidious form of taxation because it silently erodes the purchasing power of citizens while allowing governments to continue reckless spending. This is why central banks talk about a 2% inflation target. It is a hidden tax on savings, a slow-motion theft of purchasing power. However, inflation is not as tame as policymakers like to pretend. Once the public loses confidence in a currency's ability to hold value, inflation can accelerate rapidly, leading to hyperinflationary scenarios similar to what we've seen in Argentina, Venezuela, or Zimbabwe. While the US and the Eurozone are not yet at that stage, the warning signs are clear. The only asset that has historically protected against such monetary degradation is gold. This is precisely why central banks are now among the biggest buyers of gold, because they know what is coming. Silver, too, plays a crucial role in this transition. Often referred to as gold's little brother, silver has historically been an essential monetary metal. However, its current market structure is deeply flawed, with heavy paper manipulation suppressing its price. Unlike gold, which is primarily used as a store of value, silver has significant industrial applications, particularly in electronics and renewable energy. The demand for silver in solar panels, electric vehicles, and other high-tech applications is skyrocketing, yet the mining supply is barely keeping up. This presents a unique opportunity for investors who recognize the inevitable repricing of silver once the manipulation schemes unwind. Another significant development that cannot be ignored is the weaponization of the US dollar and the SWIFT payment system. The West's decision to freeze Russia's foreign exchange reserves in response to the Ukraine conflict sent shockwaves throughout the global financial system. It demonstrated that U.S. treasuries are not as safe as previously thought. If reserves can be confiscated for political reasons, then what stops the U.S. from using the same tactic against any nation that does not align with its geopolitical interests? This realization has accelerated the movement away from dollar dependence and toward gold accumulation. China, in particular, has been quietly accumulating gold while keeping its official reserve figures deceptively low. The actual amount of gold held by the People's Bank of China, PBOC, is likely much higher than what is publicly reported. The same applies to Russia, which has not only increased its gold reserves, but has also developed mechanisms for domestic gold trading that insulate it from Western financial sanctions. The key takeaway here is that gold is being used as a tool of financial sovereignty, allowing nations to escape the constraints of the dollar-dominated system. For Western investors, the message is clear. Those who fail to recognize the shift in monetary paradigms will suffer the consequences of fiat devaluation. The traditional 60-40 stock-bond portfolio model is outdated in a world where real interest rates are negative and inflation remains stubbornly high. Holding physical gold and silver, not ETFs, not futures contracts, but actual tangible metal, is the only way to preserve wealth in this environment. Despite gold's strong performance over the past year, sentiment in the gold market remains surprisingly negative among mainstream investors. This is a classic contrarian indicator. Historically, the best time to buy gold has been when institutional investors are ignoring it. We are still in the early stages of a long-term bull market in precious metals, and those who accumulate now will likely see significant gains as fiat confidence erodes. The mining sector, too, presents an incredible opportunity. Many gold and silver mining stocks are trading at absurdly low valuations relative to the price of the underlying metals. This divergence is unsustainable. As more investors realize that mining stocks provide leveraged exposure to rising metal prices, we could see a massive influx of capital into the sector. The key, however, is selectivity. Not all mining companies are created equal, and only those with solid balance sheets, high-quality assets, and competent management teams will benefit from the coming gold and silver boom. Looking ahead, we can expect increasing volatility in global markets as governments continue their futile attempts to paper over the structural weaknesses in their economies. The fiat experiment, which began in earnest in 1971 when Nixon severed the dollar's last tie to gold, is reaching its final stages. Every fiat currency in history has eventually failed, and there is no reason to believe the US dollar or the euro will be exceptions. In conclusion, the fundamentals driving gold and silver higher have never been stronger. The collapse of fiat purchasing power, central bank gold accumulation, the rise of alternative monetary systems, and the structural deficiencies in the Western economic model all point to one inevitable outcome. Gold and silver will play an increasingly dominant role in global finance. Investors who recognize this reality and position themselves accordingly will not only preserve their wealth, but will also benefit immensely from the unfolding monetary reset. Those who ignore it will suffer the consequences of a failing fiat regime. The choice is clear: own gold and silver, or watch your savings evaporate as the final act of the fiat era plays out.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.